Welcome everyone to the Mann Chartered Financial Planners webinar as we count down to the tax year end. My name is Alison Page and this is my colleague Ed Evans. Please note this webinar is being recorded. If you have any questions, feel free to pop them into the chat or of course get in touch with us after the event. So right, Ed, over to you.
Thank you, Alison. And if you kind enough just to move us on to the first slide, please. Nice introductory one for you. Hi, everybody. My name's Ed Evans. I'm an advisor at Mann Chartered Financial Planners. Alison on the call with us as well, as is Robert Stringer. And we are a senior partner practice of St James's Place. I know that many of you who are here today are already working with us and familiar with the work that we do, but for those of you that are not or are new to us, we are financial planners, and Alison, the next slide tells us a bit about what it is exactly that we do on a day-to-day basis, or the role of an advisor. Primarily, what we do is helping our clients understand their financial goals and aspirations. That may be both in relation to personal lives, but equally applies to commercial business lives for those of you who are small business owners. Primarily what we're about is helping people to build a financial plan, which helps them achieve all of those priorities, and in doing so using the various financial assets at their disposal, some of which you can see on the screen there: income, pensions, protection, investing, cash savings, estate planning, to name a few. But of course, one of the key considerations in any successful financial plan is to keep you as tax efficient as possible, which leads us, of course, to our topic for today. Alison, if you'd be kind enough to switch, please. So nothing can be said to be certain except death and taxes. And taxes apply, of course, to everyone in different ways. We have income tax, capital gains tax, inheritance tax, for some of you, corporation tax, VAT, all sorts of approaches that are available to help bring down tax liabilities. And that, of course, depends on exactly what those liabilities are and what your personal circumstances are. Broadly speaking, though, in as far as it's possible to generalize, we'd argue that the best approach is to understand your exposure to taxation at every level of your financial plan, understand the reliefs and exemptions and allowances that are available to you, use those allowances as far as you can, and only once you've used those, starting to explore more active strategies. But I think it's important to be conscious of not necessarily looking for silver bullets when it comes to tax. There aren't necessarily very many of those out there, and those that appear to be silver bullets tend to be the things that get people in trouble. The thing with allowances, and Alison, if you wouldn't mind moving us on, please, is that in many cases, it's a situation of use them or lose them. For many of these allowances that we'll go through today, they're limited to the tax year in question. If you don't use them in any particular tax year, they're gone for good and you can't get them back. The most prominent one of those, perhaps, is the ISA allowance. There are four main types of ISA that are available. I think a common misconception is that an ISA is a product or an entity in itself, when in fact it just operates as a wrapper. It's not an investment in its own right. The wrapper just determines the tax treatment of all of the underlying assets within that ISA. So some of those types that are available to people, there are cash ISAs, which is essentially a savings account, but with that ISA wrapper around it. There are stocks and shares ISAs, which wraps up investment funds among various types, which we can go into in the future. That might include government bonds, corporate bonds, commercial property, for example, all sorts of different options there. Innovative finance ISAs. They're relatively new. When they were introduced, it was seen as a way of getting peer-to-peer lending moving across the country, hopefully stimulating some more business activity. I think it will probably be fair to say that it hasn't gone quite as successfully as the government might have hoped at the time, but nonetheless, it is out there as an option. typically a little bit higher risk, as you might expect from a peer-to-peer lending structure. And lifetime ISAs, which are the newest form, originally intended to help first-time buyers get on the property ladder, subject to various constraints. If they're not used to buy a first property, they can also play a role in retirement planning, but various considerations at play there. The key appeal of them at the time was the additional 25% bonus that the government would provide for contributions up to 4,000 a year, so 4,000 put in with 1,000 as the government bonus. As of last week, there is potentially the prospect to extend this further with the so-called British ISA, but consultations ongoing with that and yet to see exactly what it'll look like. Cash ISAs historically have been by far the most popular ISA in the UK by an enormous majority. And the reason that's interesting is that cash ISAs are not necessarily the most effective or efficient use of the ISA allowance. First of all, as with any savings account-esque product, you need to make sure that the interest rate is competitive. And in many cases, there are savings accounts out there outside that ISA wrapper that will beat those interest rates. If your plan is to keep the assets within or the cash within that ISA for more than 5 years, there may be a better use case for starting to think about stocks and shares ISAs, particularly on account of the higher growth potential. And what that means is there's greater relative value in the freedom from income tax and capital gains tax that is associated with the ISA wrapper. Another reason for that is that cash savings are also covered by other allowances, which we'll touch on in a second, which can mean that you actually derive no particular additional benefit from having a cash ISA in place, as opposed to diverting that wrapper elsewhere. For large cash holdings, though, that you're intending to keep as an emergency reserve, or that you want as your rainy day fund, or for short-term uses, the ISA wrapper can be a really valuable opportunity to avoid being taxed on your interest. Key reason behind that is that it doesn't take very much for tax to massively reduce the effective interest rate that you're earning. If you're a higher rate taxpayer, say, and you've used all of your interest allowances elsewhere, a 5% interest rate on your savings account becomes in reality a 3% rate once you take into account 40% tax on all the interest that you're earning. But in many cases, those existing allowances are enough to cover the interest that's being paid from cash deposits, and that's your personal savings allowance. Alison, if you wouldn't mind moving us on to the next slide, please. So the personal savings allowance is the reason why, in many cases, an ISA wrapper may be unnecessary for your cash deposits. Every taxpayer has a personal savings allowance, but the amount that's available depends on their wider tax status. So as you can see on the slide there, if you're a basic rate taxpayer, you have a personal savings allowance of £1,000 a year. If you're a higher rate taxpayer, that reduces to £500. And if you're an additional rate taxpayer, that reduces to £0. You do technically still have that allowance, but it's at the generous sum of £0. Any interest that you earn in the tax year below your personal savings allowance is essentially treated as tax-free. So if you're a basic rate taxpayer, you can earn £1,000 in interest without paying any tax on it. Anything above that level then becomes subject to tax. So what that means is, if you're a basic rate taxpayer, for example, and you have your cash deposits in the bank, all of the interest that you're earning may well already be tax-free, meaning that using the tax advantage of the ISA wrapper is redundant in the case of those cash deposits, which obviously defeats the main purpose of the cash ISA. That's very different, of course, if you're an additional rate taxpayer, where with every bit of interest that you earn, you're paying 45% tax on it. But then it comes into a larger conversation around the purpose of the funds involved and what it is exactly that we're looking to achieve, particularly when we're thinking about those longer-term 5-year plus projects where the stocks and shares approach may be more beneficial. For many years, the question of the personal savings allowance and the cash ISA wrappers was a little bit more simple. in a world where interest rates are 1%, the question is rather different. But in a world where we're seeing much higher interest rates on savings accounts, suddenly people who previously were paying no tax at all on their interest are starting to find themselves in a position where it is becoming taxable, at which point obviously there are certain considerations when you think about to keep things nice and tax efficient. Next slide, please, Alison. So when it comes to using your ISA allowance, what are some of the things to think about? Well, as in any financial planning situation, broadly speaking, it's prudent to keep an emergency cash reserve in place. And that's an entirely subjective question within certain parameters. But beyond that, cash can often be deployed more efficiently by pursuing other long-term ambitions. And that's in particular where those stocks and shares ISAs come in. The reason for that, as I alluded to earlier, is that the great advantage of the ISA wrapper is the fact that no income tax and no capital gains tax is payable on any income or gains that arise within that ISA. If you're operating a long-term stocks and shares portfolio, there's a much larger chance that the growth in the income you derive from it is going to be substantial compared to cash deposits attracting interest. So relatively speaking, that's where the advantage of using that allowance for stocks and shares rather than cash starts to become a more interesting question. Typically, when we speak to people, there is a bit of a misconception around stocks and shares ISAs that they're inherently risky things. Of course, there is risk associated with investing and various types of risk associated with investing. But what I think is interesting to note is that you can have a stocks and shares ISA that doesn't have a single stock or share in it. You could think about, as we talked about before, government bonds, UK gilts, for example, which are probably one of the most easygoing, steady investments that are out there. Liz Truss's political opinions aside. But what essentially we're trying to say is that you can find yourself in a position where you have a stocks and shares ISA that contains very low risk investments, while still being wrapped up within that broader ISA wrapper. Historically, the real assets that you are able to hold within an ISA attract a much higher level of growth, at least in historic terms, than cash does. And of course, that ISA wrapper means you can capture those additional gains without any of the income tax, capital gains tax applying to them. The only tax that ISAs remain exposed to is inheritance tax, but that's a separate conversation. I think the key thing to reinforce, and it's going to be a pervasive message today, but that's due to its veracity, is that all of this depends entirely on your personal circumstances and priorities, which is why it can be so helpful to have a conversation and get some professional advice on it. Alison, would you be kind enough to move to the next slide, please? Pensions. So if we are thinking about the long term, we're looking at that 5 years plus angle. Pensions, of course, spring to mind. The process of accumulating a pension is, in many cases, a long one, of course, maybe over the entire span of a career, many decades. But increasingly, the decumulation process is also becoming a long-term project. Alison, if you wouldn't mind moving to the next slide, please. In particular, that's due to increasing longevity. And over the last 40 years or so, we found that life expectancies have increased by around 8 years for males and 6 years for females. I think, as many people know, that's had an enormous impact on pension provision across the board. It's impacted the state pension, as the state finds itself increasingly having to pay for longer state pensions, whilst simultaneously having an aging population problem. It applies to the old defined benefits, final salary scheme arrangements, which used to be so mainstream and increasingly are pretty much outside the public sector, no longer out there. But it also means for people in the majority of cases today who find themselves having to accumulate a pension pot on the side, defined contribution schemes, find themselves having to support their lifestyle in retirement through an income that has to last them 6 to 8 years longer than it otherwise might have done. And what that typically means is that the pot has to be bigger. Next slide, please, Alison. What we're finding simultaneously, though, is that the government, increasingly cash-strapped as it is hard at work to constrain the tax advantages that pensions provide and have provided historically. So as you can see here, the annual allowance, so the cap on that you're allowed to put into a pension every tax year while receiving tax relief. In theory, you can put whatever you like into a pension, but the amount that you get relieved for tax is limited. Back in 2010, 2011, that was around 255,000, and that was steadily reduced to 40,000 in 2020 or 2014, sorry, through to 2020, 2021 tax year. As of this tax year, that's been increased to 60,000, but given current political circumstances, it's unclear whether that's going to remain in place, depending on the outcome of the election later this year. There are other allowances in place too with pensions. The lifetime allowance is a famous one, limiting the overall amount that is able to be accumulated in pension funds. The lifetime allowance is still around. The lifetime allowance charge, which is the tax that's payable on pension funds above that number, has in theory been or has been repealed temporarily. It's no longer something that's going to apply. But the Labour Party would have said they'll reintroduce it if they get into power. The lifetime allowance itself is still on the statute books for now, so it remains one of those areas that's particularly complicated and not entirely clear long term. Another element of restricting what can be put into a pension is what's called the tapered annual allowance, which is why, as you can see on the screen, there's a range of allowances from 2020-21 up to today. As your income reaches a certain level, the amount that you're able to put into that pension while receiving tax relief is steadily tapered away until ultimately you're limited to putting in 10,000 at the moment. It was 4,000 a year before. So once you're earning a suitably substantial income, it tends to start kicking in around the 250,000, 260,000 mark. You find your ability to use those pension allowances substantially reduced. That said, there are, of course, a huge number of advantages that continue to be associated with pensions, and they remain hugely attractive for those reasons. The main one is the tax relief that is available on eligible contributions, essentially getting a refund of the tax that you've paid by the government once you put something into the pension. Once that contribution is invested in the pension, you benefit from tax-efficient investment growth, given some of the tax advantages that are available to pension funds and their investments. At the point of retirement, there's 25% of the pot that you can take as tax-free cash, currently subject to those lifetime allowance restrictions. One of the really valuable elements of pension planning, one that tends to be a little bit less well known, is the fact that they are outside your estate for inheritance tax. So pension accumulation can be a really effective way of managing inheritance tax liabilities. And tied up with that, there's a lot of options for beneficiaries in an inheritance scenario that can make pensions very attractive from a tax planning angle. One thing that's particularly relevant is what's called the 60% tax trap, and this is where pensions can make a huge difference. I think the 60% tax trap is increasingly well known, but for those who are unfamiliar with it, once you start earning over £100,000 a year, your personal allowance, which is at the minute the £12,570 you can earn every year without any tax applying, or strictly with a 0% tax rate applying. Once you start earning over £100,000 a year, that personal allowance is steadily tapered away. So for every £2 you're earning over 100 grand, £1 is being taken away from that personal allowance. And what that means in practice is that for every £100 you're earning over that 100 grand mark, you're taking home only £40. £40 is being deducted through higher rate tax, as you would expect normally. But you're also losing another £20 from income that was previously under that 0% tax rate and has suddenly been pushed into the 20% basic rate tax bracket. What that means is every £100 that you're earning over 100 grand is being taxed at 60%. The way that you can combat that is by thinking about pension contributions. And the great advantage of pension contributions is that it reduces your taxable income from HMRC's perspective. And what that can mean is that it keeps you out of that 60% tax trap zone. If you're earning 102,000 a year, for example, it may be worth thinking about making a pension contribution to bring yourself back below that 100,000 threshold, keeping your personal allowance in full. It can also be particularly relevant when it comes to the top end, especially after the changes in last year's budget, where additional rate tax was brought down to the £125,140 mark. So in other words, as soon as you've lost that personal allowance completely, you're also being hit by 45% additional rate tax. Particularly when we look back at some of those other allowances, like personal savings allowance, once you move from higher rate to additional rate, that £500 of tax-free interest that you were able to get previously is lost entirely. That's where we start thinking about some of the advantages of making pension contributions to bring you out of that additional rate bracket back into higher rate, saving a bit of additional tax on some of those allowances that are available to you. So when we're thinking about tax efficient planning, and Alison, if you wouldn't mind just going back one slide, please. Pensions and ISAs, of course, are the basics, but the reason that they're the basics is because they are so incredibly effective when it comes to long-term tax efficiency. And it really shouldn't be forgotten that the impact that tax has on long-term compounding is enormous. The difference between a penny doubling for 100 days and a penny doubling for 100 days with 25% tax is genuinely vast, surprisingly vast. And that's one of the key advantages of having these tax efficient wrappers in pensions and ISAs that allow for compounding without the burden of taxation on a long-term basis. Depending on your circumstances, though, there may be some other opportunities to think about to manage your tax affairs. One of the main ones is unit trusts, which you can see on the screen there. Unit trusts are typically, when people talk about owning funds in this country or owning investments in this country, unless they're in an ISA wrapper or pension wrapper, often what they're talking about is strictly what's called a unit trust. Unit trusts are subject to the capital gains tax regime, and any income that you derive from them is also subject to income tax. But what that can mean is that it's a really nice opportunity to start using your dividend allowances, for example, through dividends paid from those funds. Your capital gains tax annual exempt amount, which this year is 6,000, reducing to 3,000 next year. And the reason that's valuable is that it can mean that if you're building a holistic tax efficient income strategy, you can use various resources to take as much tax-free income from various places as you can, making use of your personal savings allowance, dividend allowance, capital gains tax allowance, as well as tax-free income from ISAs, your pensions tax-free cash, all of the things that we've talked about previously. Capital gains tax is a particularly interesting one. It's one that, as with so many of these allowances, finds itself under attack by the Treasury, but it's fallen a lot in recent years. Last year it was 12,300, the amount that you could crystallize in gains without paying any tax, and as I say, falling currently. But there are still some opportunities to make use of that allowance before the end of the tax year. One thing in particular that tends to be less well known is thinking about realizing losses that are on assets that you tend to sell anyway, particularly if you're with a view to using those losses, taking them forward through time and offsetting them against gains in the future. But also some of the shorter term considerations. Some of you may be familiar with the idea of bed and breakfasting, which was an idea of the past where shares might be sold and rebought in 2 different tax years with the view of realizing gains. That's no longer possible due to changes in legislation, but there are still some opportunities out there, such as thinking about what's called a bed and ISA approach instead. that's the unit trusts direct equities angle. Investment bonds tend to be a little bit more unusual, but can provide some really useful additional flexibility when it comes to tax planning. They're particularly valuable when it looks like the amount of income tax to which you're exposed is going to change in future years, particularly, for example, in retirement scenarios. They can be held onshore, they can be held offshore with various tax treatments associated with that. Where they can come in incredibly helpful is in planning for inheritance tax, thinking about using trusts, for example. Lots of opportunities to use those too. Pensions, of course, we talked about, are always going to be the, at least at the minute, are the number one tax efficient strategy. And there's also the nicher end of the tax planning world with things like venture capital trusts, VCTs, enterprise investment schemes, EIS, seed enterprise investment schemes, SEIS. Those are typically very, very high risk. They have very generous income tax exemptions, largely because the government wants to incentivize individuals investing in early stage companies, kickstarting economic growth and all the rest of it. But the flip side of that very generous tax relief is that there is a genuine risk of losing everything that you put in. So there is, it tends to be, or those types of planning tend to be appropriate only where capital is available for disposal, and you wouldn't miss it if you lost it. So obviously that tends to be fairly unusual cases. There are, in addition, and Alison, if you wouldn't mind moving to the next slide, please, some other exemptions that are perhaps less well known, particularly in the world of inheritance tax. Inheritance tax is one of those taxes where there are a good range of different opportunities to mitigate it, which is advantageous. In the short term, though, there are some gifts that can be made, and particularly it is gifts in particular that can be made without any inheritance tax implications, which can be very useful from a planning perspective. Most people are aware of the 7-year clock that starts ticking once you make a gift. With these, there are no 7-year clocks ticking at all, so it can be a very useful way of getting money outside the state. The main ones are thinking about small gifts, up to the value of £250 per person, which you can make to an unlimited number of times in a particular year, as long as it's not to the same person. There's an annual gift that you can make of £3,000. You can also use the previous year's gifting exemption if you didn't use it at the time, so up to £6,000 that you can give in one go. Wedding gifts, if relevant in some circumstances. A parent can give a child up to £5,000 in consideration of their wedding, inheritance tax free. Grandparents can do the same, and so can others, but those numbers fall from 5,000. You can make regular gifts from your income, and as long as it's not impacting your standard of living, all of those are treated as inheritance tax free. And of course, you can give gifts to charity to an unlimited amount, and all of those are exempt from IHT as well. Perhaps a more unusual element of your everyday tax planning, but still very helpful, particularly for those with large estates. Alison, if you wouldn't mind moving to the next slide, please. So, in summary, and this has been very much a high-level overview, key things to think about in advance of the new tax year: your ISA allowance. Are you making use of your £20,000 ISA allowance? But secondly, are you making the most efficient use of that allowance? For some of you, junior ISAs may be relevant as well, with their £9,000 annual allowance. Personal savings allowance. Have you got the right balance there between that emergency cash fund, but also thinking about deploying excess cash more effectively? Also making sure that you're using that personal savings allowance as much as you can. And if you're falling over that 1,500 zero limit, whatever it happens to be, have you thought about alternative options? Pensions. Are you getting the most out of the tax efficient benefits that are available to you there? Are you using your allowance to its full potential? Have you thought about the other options that are available to you? Capital gains tax may be relevant, may not be relevant, but are you making use of that £6,000 allowance before it not only disappears, but is reduced to £3,000 in future tax years? Dividends, are you particularly relevant, in fact, for small business owners? Are you making efficient use of your dividend allowance, reducing your overall tax bill? But equally, are you finding yourself falling foul of that increasingly restricted dividend allowance, falling from 2,000 to 1,000 to 500 going forward? How do we make sure that you can continue to receive dividends in as tax efficient way as possible? And inheritance tax, not going to be relevant for many of you on the call, maybe relevant to some of you. Are you in a position where you're maximizing your opportunity to move money outside your estate, such that that inheritance tax bill ultimately is mitigated as much as possible? As has probably become clear throughout this presentation, all of these points are very subjective things. They depend entirely on your personal circumstances, but also on your personal ambitions, what it is you're trying to achieve and why. And that's why we would suggest that if it's something you're interested in exploring further, please do give us a call, send us an email. We'd be very happy to run through a quick tax health check with you, figure out what your exposure to taxation is. Is there anything you can do better? Have we thought about using all of your allowances ahead of the imminent tax year end? And hopefully getting you into a position where long term you're more aware of what the taxes are that you're exposed to and more efficient in how you're allocated to deal with them.